Well, hello there, everybody. This is Morris from San Jose Options, and I want to talk just a few minutes about the recent market crash, if you will, from August 2015. As you see in the price chart in front of you of the SPX, you can see how the market started to just fall off a cliff here, and actually the market drifted down a little bit further from when I took this picture. This was from the 21st, and then the 24th was another really down day. And so, one second. So during this time, needless to say, there were a lot of stock traders as well as option traders that were hurt a lot. I'm going to cover a couple of the popular strategies that really took a bloodbath during that time, and where these strategies come from, why people use them, and so on. And then at the end, I'll show you some of the performance from our program, how we did over that crash, and so you can see the difference, hopefully, from designing your trades set up for that type of situation. So you can go ahead and read through this. I don't want to waste, just pause the video and go ahead and read through, but I want to cover a couple of the popular strategies. So the first one here, this is a calendar spread, and what I did was I recreated this trade, and then I basically back tested it. And so this is a 30-day calendar created on the SPX, and if you had this trade on, then through that part of the crash, this trade was down, this part over here, the 52%, the bar represents your final expiration location. So the bar here is 84% down, but the current day step line was about 50, almost 53% down. And that was on the Friday. So then on the Monday, the market went down even further, way over here. So that trade was probably down about 80-something%. Okay, so I want to talk about this calendar spread for just a moment, because a lot of the educators and a lot of traders out there will put on this trade in hopes of protecting their account with positive vega. However, first of all, the trade, even though it reads, it has an output of a positive vega, it doesn't always behave as if it's really truly a positive vega position. So you have to understand that there's two different months here, and if your front month volatility rises faster, then even though, again, it shows it's positive vega, the trade could lose money. Also, the trade can actually make a profit when the volatility drops. For the same reason, the front month could drop faster. So it's really deceiving to believe that this trade here is positive vega and it'll give you a profit when volatility rises, because it's simply not true. Those aren't the facts. The other point to this trade is that, as you can see through here, if the market moves a substantial amount, then the trade, the vega position doesn't matter, because the curve here, which we're creating from the gamma position, is just, it's so reckless that it's just getting crushed and destroyed. So again, if you think you can put on a calendar and it'll hedge the vega in your portfolio, just keep in mind it's only going to work in a really narrow area, like as you can see here in the picture. But any substantial move, and then the trade will get hammered. Next, let's look at the credit spread. So this is another popular one. A lot of people want to make money with stocks or options just really, really fast. And so to do this, they move their trades up in time, or they do the most mature options. For example, only a week out. So I created this trade, just again did a back test. This was about 7 days out, and then with the fast move down, look where it was, down 68% in just like 3 or 4 days there. And then of course the next Monday the market went down further, so this trade would have been down probably 80 or 90% as well, and then would have expired over here at 100% loss. So again, this is what happens when you try to make money too fast. Next, we'll look at a similar trade, but longer term. So this is another really popular one. It's a monthly credit spread where you go a little farther out in time, maybe 30 days to 60 days. This one, I can't remember if I rebuilt 30 days or 60. But you can see that again, just in a few days here, this trade was down about 40%. And then the following Monday went down here, so it's down about 50%. Again, just in a week. So when you put these trades on, this is the problem. You're opening your portfolio up to all this risk. So although these strategies may work for a year, maybe it's worked for since 2011, like 3 or 4 years, but then you can have one bad week, and then if you're almost fully invested, then you can really experience these drawdowns, 80%, 100%, 40, 50%. Another thing to consider is that typically it doesn't matter if you diversify into 10 or more credit spreads, because again, when the market crashes like that, everything correlates and everything crashes. So that's just going to create a lot more work for you, because you're going to have 10 to 20 different trades that you're trying to manage at once, and it'll be really, really impossible, because you'll be, again, when you're managing your trades, you don't just click a couple of buttons. You have to analyze things, you have to see what the prices are, you have to enter your price, you have to wait, you have to change the price. Basically, you have to work every order. So if you have 10 to 20 trades on and then the market is crashing like that, you don't have time to manage that account. So again, when you have so many credit spreads to manage, and then they're all losing at the same time, that's not going to help. It's just going to make things worse. So again, why are these trades so popular? Well, again, unfortunately, those that are reaching everyone are the companies that are backed by so much money in advertising. So you have like Tasty Trade, for example, reaching 50,000 viewers per day, and I'm sure they've reached millions of viewers, and they teach this type of strategy, and they actually tell people to put it on and just base it on the POP, the probability of profit, and an IV rank of 50 or higher, and then just let it ride. Well, the thing is, when you let them ride, again, they have that saying, to let the losers ride and close out the winners. So this was just a perfect example of why that methodology does not work, because when you let all these ride and then they correlate, well, then again, 40% loss, and then it went down to about 50-60% loss. So you'd have your whole account way over here, about 50% down, and then from there you're just praying that the market goes back up. So again, if you watch their videos during that market turmoil, you'll see even Tom Sosnoff himself commenting that he's liquidating his trades at a loss, he's violating his own rules, and just shows you the rules that they teach they don't work. So, I think he shouldn't be teaching those to people. But anyway, he does a lot of these credit spreads from what I can tell, and just got him into trouble. When, again, back up here to the calendars, anyone doing these demolished. The condor spread, same thing. You would have just this side coming down, but they essentially would have been over here, about 40 to 50% drawdown during that time. So other strategies that would have been demolished. Let me show you what let me bring in something. Okay, next I want to build Karen the Supertrader's trade. So we're going to go out about 46 days. She probably had one on that was somewhere around there. So let's bring these in. So we have our delta over here. On the put side, they typically do something like around a 5 delta. So I'll pick one out and actually look at all these contracts over 5,000. That could be her right there. So we'll bring in those, and then we'll also bring in the call side. So the call side, they do somewhere around the 10 delta. You see, again, thousands of contracts. So I'll go ahead and choose the 7. Okay, so I built this trade, and in this case we have 80 short puts and 80 short calls, and you can see the deltas here, and this is very similar to the Karen the Supertrader short strangle trade that they do. So this one, as you can see, has a I guess you can't see that, but hold on a second. Okay, so I put together a short strangle, which again is very popular in the tasty trade community, brought to everybody through Karen the Supertrader in her fund, and then all the advertising through those guys. So here you see a trade. The margin's off the screen, but it has about $900,000 margin on with a portfolio margin account, because that measures about 10% down and up. So it's measuring somewhere over here, and then the 10% side. So it's getting the margin from this point, which is close to about 900,000. So watch what happens to this trade with a $900,000 margin. So I'm going to fast forward to the 24th, and then we'll see what happens to it. So market moved this way, volatility increased, and the trade is down about $600,000. Okay, so let's back up just a moment. So this trade had a margin of about 900,000, and then it lost 600,000. Okay, so we have about a 40% loss there in just a week with this trade setup. The other thing, again, it's off the screen, but the margin from this point goes up tremendously. So what happens is, if you're trading this, and you most likely get a margin call because your the buying power on this now totally changes, because your new 10% mark is over here. And so you can see that that jumped up to about $1.5 million. It almost doubled. So basically, when you get over here, you lose the 40%, or in this case 600,000, but then you can't continue, because most likely your account has lost tremendous amount. If you translate this information to the millions, for example, let's say Karen the Supertrader's fund was using 90 million on one trade, or maybe, well, they typically use at least 50% of their fund. So, and actually in this case, the 40%, one second, let me see something. Yeah, so the 40% actually that you're seeing over here, that's based on the new margin, which is $1.5 million. So the original loss, okay, yeah, so in our software, the return is going to change based on your buying power. So now the buying power is up to $1.5 million, and that's 40% on that. But relative to your original buying power, this trade is down 70%, or close to it, close to 70%, with the $600,000 loss on the original $900,000 buying power. So again, if you think of that in terms of the millions, then if they were using maybe 90 million, they may have lost, been down about 60 million or so. So I haven't heard all the latest updates, but if they have 200 million in there, and then they always use at least 50%, for example, so they could have lost maybe 70 million. So then their 200 million drops to 130, and then they don't have the money to stay in the trade. So then they would have to size this down tremendously, like maybe half, and then when it starts to make money back, they can't make it all back because they had to size down the entire trade. So it'll be interesting to see, what they say, if they have any more interviews on that show. But yeah, they certainly could have lost 70 million and maybe more, depending on, maybe they were increasing their size as the market went down, and then it went down further. I really don't know exactly how they managed it. But anyway, I just wanted to show you, again, this is another one brought to you by Tasty Trade, and that was down about 70% in a portfolio margin account. Pretty frightening. Okay, so before we go, I want to just talk a minute about our trading, how we did over the crash, and then just in general what's different about the way that we trade. So we set up our trades with a different architecture. So again, those trades that you're seeing that are so very popular because of advertising, they're extremely risky. And again, although they may work for a few months, maybe even a couple of years, well, when the market moves fast, they get crushed. And that's when people start to really think seriously about what they're doing with their real money. For one, you start to realize that, well, this is my savings, and it's not safe. My money's not safe. So again, the reason this happens is because those type of strategies are just heavily advertised, but they're not designed to withstand that type of move. So all of those strategies, the cover call, similar the naked put, that naked strangle we just looked at, the naked straddle, your credit spreads in either direction, your iron condor, your calendar spread, and there's more, but those, your at the money butterfly. These strategies are designed to work when the market is really asleep, okay? But as soon as that market wakes up and moves really fast, which could happen several times a year, sometimes it doesn't happen for a few years and then it happens, but it does continue to happen, and that's the thing. And then the people that trade these strategies, well, they think that they'll get out before it happens, before the market moves fast. They'll get out or they'll do something. But then when it's really happening to them, they don't. They can't get filled, or they just react too late. You know, the market moves down 5% one day, and then they're feeling like, well, if I change my position now and it whipsaws back the other way, then I'm going to lose twice. Therefore, I'm not going to do anything. And then it goes down further, and then before you know it, you're down 80%. Okay. Now, the reason these trades don't work during that type of market, well, you saw from those risk profiles that they have that strong gamma. It's that shape. Let me go back. Okay, so when I mentioned the negative gamma, I'm talking about this curve here. So you can see it down here on the credit spread. Again, look at that big move, and it just loses an awful lot. The calendar, same thing. The butterfly looks like this too. The cover call looks like that too. Okay, they all have this type of risk profile. So this is what happens when you design your trades this way. And remember, they're being marketed by not necessarily people that trade them, but by the people that process them. So remember, the market makers and the brokers that are teaching this to you, they're on the other side, so they're just processing the orders, and they don't hold them for long term. So they just see these orders coming through, and then they teach the public this is what people are doing. Doesn't necessarily mean it's right or it works. It's just these are the common orders. But you can see by design that they're not made to handle large moves at all. All of them. They're all exposed to a bearish market. Okay. There's a couple other things. So that's the gamma part of the trades. And again, your gamma describes how your delta is changing, and it's actually one of the higher order Greeks. But there's other Greeks that are missing in these, like lambda, for example. Your effects of lambda on all of these trades, it's not implemented so that it'll benefit you. Once you understand the higher order Greeks, again, the educators out there do not understand higher order Greeks. Again, I like to point out Tasty Trade because they're the largest financial network in the world, and you know, Mr. Sosnov is reaching millions of people. But if you watch his videos on higher order Greeks, he publicly says that he's never heard of them. So he has the guy Skinny come on to his show, and then Tom looks over to Tony and he says, "Tony, have you ever heard of any of these?" And then they comment, "If these were on the options test, we never would have passed." Okay, so these are your marketed educators, and they haven't even heard of the higher order Greeks. They certainly don't know how to use them. Okay, so these trades that are, again, being brought to you by so-and-so, And it's not just them. I mean, these strategies are brought to you by a lot of educators. But anyway, they don't have the lambda position in them is just horrible. There's no use of lambda at all in these. The vomma position, when we looked at that strangle that lost all that money, okay, it has a very strong negative vomma. And see, again, you have these people teaching these things to people and they don't even know how to use vomma. Okay, so that strangle position has a negative vomma, so when the vols increase, your negative vega becomes even more negative vega, and you just lose faster and faster and faster. Okay, but these people that teach you these things, they don't know that, and they don't explain that to you. Even if they did know it, they wouldn't know why. Okay, your vanna positions are also very important. So depending on how you structure your vanna, it's going to control how your vega changes as the price changes of the underlying product. So these are all very important issues that you need to think of these. If you learn how to use vomma and vanna properly, then as the volatility changes and the price moves around, guess what happens to your vega? Well, what happens to it is whatever you want, whatever you've designed. Okay? If you want your vega to remain flat and to not change, you can do that once you understand vomma and vanna. There's a lot you can do with the higher order Greeks. And again, these people that have so much money behind them, and they're just all over the internet and reaching millions of people, and they don't even know how to use these higher order Greeks. They don't even know what they are. Back to the performance page. So that's how we did it. Okay, we saw the market was moving down. We implemented a few strategies with some positive vomma. The vols increased, the profits increased. Okay, and then we also have our vanna in place so that our vega positions aren't just changing against us dramatically. We can also use a position of speed, so we can start with a flat gamma and make sure that gamma remains flat by having a flat speed as well. So again, when you understand the higher order Greeks and you know how to implement them, basically you can design trades that are going to remain stable and not get crushed when the market moves. So just the last couple minutes here. So through August, it was probably one of our best months. We had a couple finish up here on the left. You have standard margin. Over here you have your portfolio margin returns based on the TIMS plus and minus 10% calculation. And so 1%, 3%, 7%, 8%, 300%, 6, 482, 27%, 1600, 10, 149, and so on. You'll see that we have a lot of these portfolio margin trades are just making tremendous returns. Okay, and we put the standard margin next to it so you have a sense of reality, basically, because these ones appear really high, but it's not that the returns are super high, it's because the margins are really low. Okay, so just remember that the TIMS, T-I-M-S model, it has a really low way to margin your trades, like it under margins your trades, actually, for a lot of trades. So these returns are really high, but if you just want a normal sense of returns, look at the standard margin returns. Okay, but this is what we've done, through all this volatility. And then again, your most popular educators out there closing trades at losses, your strangles losing 70%, your credit spreads losing 80%, your calendars losing 90%. Okay, So there's no reason to be trading those risky strategies. In fact, look how we've done. Actually, we haven't had a loss in almost 2 years now. Okay. And so you can just see that even when vols are low, look at our returns. And then last year, returns are down here. I didn't put in the PM ones. These are just all standard margin from last year. So that's about all that I want to cover today. Just really want to reach out, let you guys know if you're trading these condors and your bull put spreads and naked puts and cover calls, and if you just really got hammered through that last move in the market. Well, I hope it, opened up your eyes and help you realize, that perhaps what you're trading isn't really going to be your best type of trade over, the next 5-10 years of your life. So if you don't want that to happen again to you, and next time you want to be more prepared and you want to have a strategy that's designed safer from the beginning, so in case we do fall off a cliff again, and we will, then you're not going to destroy your account, and then you'll make it through it, and then you'll continue to have these base hits over time, but you don't have to worry about destroying your account like that. Okay, so anyway, hope you learned a couple of tips here, and again, if you're interested in learning safer way to trade, more sophisticated way to trade, learn how to use your high order Greeks, understand lambda. It's so simple. We'll show you how to integrate lambda so you can make more money, safer money, and we'll teach you about vomma and vanna, how to set those up so your vega doesn't change on you, and how to use a flat gamma and a flat speed so your deltas remain pretty flat, and you're not constantly chasing the market around. You're just letting time work for you, and the odds and the statistical probabilities will be in your favor. Well, there's a lot to say, but anyway, give us a call. Thank you for watching this presentation.